somewhere right now.
A piece of software is worth more than most countries' entire economies. It has no factories. It makes nothing you can hold. Its warehouses or server racks in Virginia and Oregon and Singapore, and yet it prints money. Or in some cases, burns it by the billion, based on one strange currency: your attention. This is the economics of owning a social media platform, not the culture war version, not the is it good for society version, the actual balance sheet, the unit economics. The reason some of these companies are worth $1 trillion, and others, with just as many users, can't turn a profit to save their lives. By the end of this, you'll understand why a platform with 300 million users can be worthless, why one with 30 million can be worth $30 billion, and why the person who owns the platform, not the people using it, is really the one being sold. Let's start with the strangest part of this business. What, exactly, is being sold? And to whom? Every social media platform is what economists call a two-sided market. That means there are two distinct customer groups, and the platform's entire value comes from connecting them. But only one of those groups is usually paying. Side 1, users. You, me, your cousin posting vacation photos. We don't pay a subscription. We pay with something else: our time, our attention, and the data trail we leave behind every time we scroll, pause, like, or linger 3 extra seconds on a video. Side 2, advertisers. They're the ones who actually write the checks. And what they're buying isn't access to Instagram or a slot on TikTok. What they're buying is precision, the ability to put a message in front of exactly the right eyeballs, at exactly the right moment, for exactly the lowest price the auction will allow. This is the fundamental trick of the business model, and it's worth sitting with because it explains almost everything else. The product isn't the app. You are the product, in the sense that your attention and your data are the inventory being sold. But more precisely, and this matters for the economics, the product is a bet. Advertisers are buying a probability that showing you this ad at this moment, in this feed, increases the odds you'll do something: click, buy, download. Remember a brand name. That means a platform's core economic asset isn't its user count. It's the quality of its prediction engine. How well it can guess what will keep you scrolling and what will make you buy. That prediction engine is worth more than the app itself. It's why Meta's algorithm is worth more to Mark Zuckerberg than every photo ever uploaded to Instagram combined.
And here's the twist that catches a lot of new platforms off guard. Growing your user base doesn't automatically make you profitable. In fact, in the early years, more users usually means more losses. Every new user costs money to serve: bandwidth, storage, content moderation, customer support, before that user has generated a single cent of ad revenue. You're paying to acquire a customer whose future value is, at best, a guess. This is why so many platforms chase engagement above almost everything else in their early years. Engagement is the leading indicator investors use to bet on future ad revenue, long before the ad revenue actually exists. A platform that can prove people check it 15 times a day is a platform that can raise money on the promise that monetization will eventually catch up. Sometimes it does. Sometimes, and we'll get to painful examples of this, it never does. So how does a platform actually make money? There are more paths than people assume, and the mix matters enormously for how a company is valued. The first, and by far the dominant model, is advertising, sold through an auction. When you open an app and an ad appears, you just witnessed the tail end of a real-time bidding war that happened in the time it took the page to load, often under 200 milliseconds. Advertisers set a maximum bid and a target audience. The platform's algorithm scores every eligible ad for every available slot, weighing the bid amount against a predicted probability that you'll actually engage with it. Highest expected value wins the slot. This happens billions of times a day. The genius of this system, from the platform's side, is that it turns attention into a nearly infinitely divisible commodity. A television network sells 30-second blocks to the highest bidder, and that's that. A social platform can sell a slightly different ad to every single person scrolling the same feed, at a price calculated individually for each of them. That's a fundamentally more efficient way to monetize attention, and it's why digital ad spending has swallowed an enormous share of global advertising budgets. The second model is subscriptions, a much older, simpler idea, but historically much harder to make work in social media specifically. Why? Because subscription revenue caps out at whatever fraction of your user base is willing to pay, while advertising can, in theory, extract value from every single user, even the ones who'd never pay a dime. A platform moving toward subscriptions is often a platform whose ad business has matured or plateaued, looking for a second growth lever, or one under regulatory pressure to offer an ad-free option. The third model is commerce and transactions. Platforms taking a cut when creators sell something, when users tip, when a live shopping event closes a sale. This model ties platform revenue directly to real economic activity happening on top of it, rather than just attention. It's structurally different because it scales with commerce volume, not just impression volume. The fourth, and the most quietly important, is data licensing and platform services, API access fees, data partnerships, and increasingly, licensing content and interaction data to train other companies' systems. This has become a meaningful new revenue line for platforms sitting on enormous archives of text and images. Here's the part that surprises people. These revenue streams are not equally profitable per dollar. Advertising, once the infrastructure is built, has extraordinarily high margins. You already paid to build the algorithm and the servers, so each additional ad sold is close to pure profit. Commerce has real margin, but you're sharing revenue with sellers and payment processors. Subscriptions look great on paper, but come with support costs and churn. This is why, again and again, when a platform is deciding where to invest its engineering time, advertising infrastructure usually wins the argument. Even if leadership says publicly they're diversifying revenue. Everyone loves talking about how social platforms make money. Almost nobody talks about what it actually costs to run one. And the cost structure is where a lot of the real economic drama happens. Start with infrastructure. Every photo, video, and message has to be stored, replicated across data centers for redundancy, and served instantly to whoever requests it, anywhere in the world. Video is punishingly expensive. A single minute of high-definition video uploaded once might be viewed, reviewed, and reserved millions of times. That's why platforms invest so heavily in compression technology and content delivery networks. Shaving even a small percentage off bandwidth costs at that scale saves enormous sums. Then there's the cost that barely existed 20 years ago and now can be a company's single largest operating expense after infrastructure, trust and safety, content moderation. At scale, this isn't a small customer service team. It's tens of thousands of human reviewers, often contracted through third-party firms, working alongside machine learning classifiers that pre-screen content before a human ever sees it. This is an optional overhead. Advertisers will not put their brand next to certain content, and regulators in multiple countries can levy fines that make moderation look cheap by comparison. Then, engineering talent. The algorithms that decide what appears in your feed, what ad to show you, what content to recommend. Next, these are maintained by some of the most highly compensated engineers and researchers in the world, because a 1% improvement in engagement prediction across a billion users translates into enormous revenue. This creates an unusual dynamic. A platform with 100 million users might need a smaller engineering org than you'd expect, but each of those engineers is extraordinarily expensive because the leverage of their work is so high. And finally, there's a cost category that's easy to forget until it isn't: legal and regulatory compliance. Different countries have different data laws, different content laws, different tax structures. A platform operating globally effectively has to build and maintain dozens of parallel compliance systems. This has become such a significant cost that it now shapes which countries some platforms choose to operate in at all. Put this all together, and you get a business with a strange cost curve. The first user is astronomically expensive. You've built the entire infrastructure, hired the trust and safety team, built the ad auction system for just one person. The 10 billionth user is nearly free to serve. This is why social platforms either become extraordinarily profitable once they cross a certain scale threshold, or they never cross that threshold and bleed money indefinitely trying to get there. Let's talk about why some platforms seem economically invincible and others collapse the moment a competitor shows up. The answer is network effects. And it's the single most important economic concept in this entire industry. A network effect means the platform gets more valuable to each user as more people join it. Your favorite platform is valuable to you largely because your friends are on it. The creators you follow are on it. The communities you care about live there. If everyone left for a competitor tomorrow, the platform you're on would become worthless to you within days, regardless of its features. This creates a specific kind of economic moat that's very different from, say, owning a patent or having lower manufacturing costs. It's a moat built entirely on the coordination problem of getting everyone to leave at the same time. Individually, no single user has enough incentive to switch platforms first, because the new platform is empty. This is why so many Twitter killers over the years have struggled, not because the product was worse, but because the switching cost isn't really about the product. It's about the fact that leaving alone means leaving your social graph behind. This is also why the death of a social platform, when it happens, tends to happen suddenly rather than gradually. Network effects work in reverse too. Once enough people start leaving, the platform becomes less valuable for everyone remaining, which triggers more people to leave, which accelerates the collapse. Economists sometimes describe this as a phase transition. The platform can look stable right up until it very quickly isn't. This dynamic has a direct financial consequence. It makes social media valuations incredibly sensitive to sentiment and momentum in a way that, say, a utility company's valuation is not. A utility's value is tied to predictable infrastructure and regulated returns. A social platform's value is tied to a belief about whether the network effect is strengthening or weakening, and that belief can shift in weeks based on a single high-profile user exodus, a competitor's viral feature, or a change in an underlying algorithm that damages trust. This is precisely why owning a social platform is such a different kind of asset than owning, say, a media company with a library of copyrighted films. A film library holds its value whether or not anyone is watching this week. A social network's entire value can evaporate if the network effect reverses, even if the underlying technology is untouched. So let's get concrete. What does it actually cost to own one of these things, and what determines the price? When investors or acquirers value a social platform, they're rarely valuing it like a traditional business, based on current profit. They're valuing it based on a projection of future monetization potential per user, multiplied by an assumption about how large and durable the user base will be. This is why you'll hear metrics like average revenue per user, often shortened to ARPU, treated almost like a stock price in its own right. A platform with low ARPU but a young, large, fast-growing user base is often valued more highly than a platform with high ARPU but a shrinking one, because the market is pricing in future monetization catching up to the audience. This produces some strange outcomes. A platform can have a massive valuation while being unprofitable, because investors are effectively betting that once growth slows, management will turn on monetization, introduce more ads, raise prices, add premium tiers, and profit will follow. This bet doesn't always pay off. Plenty of platforms have hit a wall where they simply can't monetize as aggressively as their valuation assumed, either because the audience won't tolerate more ads, or because the advertisers willing to pay premium rates were never as numerous as projected. There's also the acquisition case, where someone buys an existing platform outright rather than building one. The economics here are unusually punishing, because you're often paying a price based on the platform's peak cultural relevance and audience size, while simultaneously inheriting all of its costs, the infrastructure, the moderation obligations, the engineering headcount, on day one, with no ramp-up period. If advertiser confidence dips after the sale, which is common during any change of ownership, revenue can fall sharply while the cost base stays fixed. This is the mechanism behind some of the most dramatic recent examples of a platform's valuation collapsing. After a change in ownership, the buyer inherited a cost structure sized for a much larger advertising business than what actually materialized. Post-acquisition, the lesson from these cases is consistent. Owning a social platform means owning a bet on continued advertiser trust and continued user engagement simultaneously. And those two things are more fragile and more tightly linked to each other than most acquirers initially appreciate. Advertisers watch user sentiment closely because they don't want their brand associated with a platform in decline. And users watch, whether consciously or not, whether the platform still feels alive, still feels like where the culture is happening. Damage either one, and the other tends to follow. There's one more variable that increasingly shapes the profitability of owning a social platform. And it's not a market force at all. it's regulation. Data privacy laws can directly reduce ad targeting precision, which directly reduces what advertisers are willing to pay per ad slot. When a major regulatory change restricts the kind of tracking a platform can do, the immediate financial effect is a drop in ad efficiency, and that shows up straight on the revenue line. This has happened more than once in the past decade, and each time, platforms have had to rebuild entire measurement systems to try to recover the lost precision through less invasive means. Antitrust action is another force entirely. A platform that has grown large, partly by acquiring potential competitors, faces a different kind of risk. The possibility that regulators force a breakup or block future acquisitions that would have extended its dominance. This changes the economic calculation for how aggressively a platform can pursue growth through acquisition versus organic competition. And then there's content-related regulation, rules about what must be moderated, how quickly, and under what liability. Every new compliance requirement here adds fixed costs that hit smaller platforms, disproportionately harder than large ones. Since moderation infrastructure has significant economies of scale, this is one of the quieter reasons the largest platforms tend to entrench, rather than fragment over time. A regulatory compliance burden that a $5 billion company can absorb easily might be existential for a $500 million challenger. The overall effect of regulation on this industry's economics is to raise the fixed costs of doing business at all, which tends to favor incumbents who can spread those costs over enormous user bases, while making it more expensive for new entrants to ever reach the scale where the business becomes profitable in the first place. So where does this leave the economics of owning a social platform going forward? A few forces are reshaping the model right now. Short-form video has pushed infrastructure costs up further, since video is dramatically more expensive to store and serve than text or images, even as it's proven to be the format that holds attention most effectively, which is exactly the trade-off that defines this whole industry. Attention and cost rise together. Artificial intelligence is changing both sides of the ledger simultaneously. On the cost side, AI-generated content moderation and AI-assisted customer support are lowering some operating expenses. On the revenue side, AI-powered ad targeting and AI-generated ad creative are increasing what advertisers are willing to pay because the predictions are getting sharper. But AI is also raising a new cost. Platforms are increasingly having to defend against AI-generated spam, fake engagement, and synthetic content at a scale that didn't exist a few years ago. And there's a slower-moving but real question about whether the advertising-funded model itself has a ceiling. As more of a person's daily attention gets divided across more platforms, each platform's share of that attention shrinks, which puts long-term pressure on ad rates industry-wide. This is part of why subscription and commerce revenue, historically the smaller pieces of the puzzle, are getting more serious strategic attention across the industry, not because they're more profitable per dollar, but because they don't depend entirely on winning an ever more fragmented attention war. If there's one closing idea to take from all of this, it's this: owning a social media platform is not like owning a factory, or a media library, or a piece of real estate. It's owning a live, fragile agreement between millions of strangers to keep showing up, and a bet that you can keep selling access to their attention for more than it costs you to hold it. Get the balance right, and it's one of the most profitable business models ever devised. Get it wrong, and you can own the most popular app in the world and still be losing money every single day. That, in the end, is the real economics of the social media platform business, not the algorithm, not the app, not even the users. It's the balance between attention, trust, and cost, held together for as long as the network agrees to stay. If this changed the way you think about the app you're scrolling through right now, do 3 things for me. Subscribe so you don't miss the next breakdown. Drop a comment with the platform you'd want me to run these numbers on next. And if you know someone who'd find this genuinely useful, send it their way. That's how this channel grows. Not an algorithm, just people passing along something worth their time. Thanks for watching. I'll see you in the next one.